Imagine sending one digital dollar across the world in seconds without waiting for a bank wire to crawl through the system. That is the promise behind stablecoins. A stablecoin is a crypto token designed to keep a stable value. Most people are talking about stablecoins that try to stay close to $1. That is why you will often hear them described as digital dollars. Bitcoin and many other crypto assets can move sharply in price. That volatility can be exciting for traders, but it is not ideal if you just want to pay someone, save money, or move funds between exchanges. If a coin can lose value before your coffee cools down, it is hard to use as everyday money. Stablecoins try to solve that problem by giving crypto users something that behaves more like cash. The key word is peg. A peg means the stablecoin is trying to track another asset. For dollar stablecoins, the target is simple. One token is meant to be worth about $1. A stablecoin does not stay stable because the logo says $1. Something has to support that price. Different stablecoins use different methods, and the method matters a lot. The most common type is issued by a company or organization that says it holds reserves. In simple terms, users give the issuer money, and the issuer creates stablecoin tokens that represent claims on that value. Think of a ticket booth. You hand over $1, and you receive a digital ticket that is supposed to be redeemable for $1 later. In crypto language, creating that ticket is called minting. The reverse process is called redemption. A user sends the stablecoin back to the issuer and receives regular money in return. If people trust that redemption works, the token is more likely to trade near $1. If a stablecoin trades for slightly less than $1, professional traders may buy it and redeem it for $1 if redemption is available. If it trades above $1, new tokens can be created and sold. This pressure helps keep the price close to the peg. If this kind of clear tech explanation helps you, consider subscribing. We keep things beginner-friendly, practical, and focused on what the technology actually does. Now, let us go one level deeper into what backs these digital dollars. Reserves are the assets held behind the stablecoin. For a dollar stablecoin, reserves might include cash or very liquid financial assets. The important question is whether those reserves can actually cover redemptions when users want their money back. Not all reserves are equally safe or easy to sell. Cash is simple. Short-term government debt is usually considered liquid. Riskier assets can create problems if many users try to redeem at once. A stablecoin issuer can face a problem similar to a bank run. If everyone wants to redeem at the same time, users need confidence that the issuer can meet those requests without delays or losses. That is why transparency matters. Users want to know what is in the reserve, who holds it, how often it is checked, and whether outside professionals review the information. Trust is not just a feeling, it comes from evidence. With many stablecoins, you are not only trusting software, you are also trusting an issuer. The issuer manages reserves, handles redemptions, follows rules, and depends on banks and other partners. If any of those pieces fail, users can be affected. There is also technology risk. Stablecoins live on blockchains, and blockchains can have congestion, outages, hacks, or expensive transaction fees. A stable value does not automatically mean the whole system is risk-free. Some stablecoins use smart contracts. These are programs that manage tokens on a blockchain. If the code has a serious bug, attackers may exploit it. This is one reason audits and cautious design matter. Centralized stablecoins are issued by identifiable organizations. They are usually easier for regulators and businesses to understand, and they can be designed for redemption through traditional financial channels. The trade-off is that users depend on the issuer. Another model uses crypto assets as collateral. Instead of holding dollars in a bank, the system locks up crypto assets in smart contracts. Because crypto prices can fall, these systems often require more collateral than the value of stablecoins created. Over-collateralization means putting in more value than you borrow or mint. For example, a user might need more than $1 worth of crypto to create $1 worth of stablecoins. This gives the system a cushion if collateral prices drop. If the collateral falls too much, the system may sell it to protect the peg. This is called liquidation. It can help keep the stablecoin backed, but it can also be stressful during fast market moves. Some stablecoins have tried to rely mainly on algorithms and market incentives rather than strong reserves. These designs can be fragile if confidence disappears. A stablecoin needs more than clever math if users stop believing it can hold value. The biggest misunderstanding is thinking that stable means guaranteed. Stablecoins are designed to be stable, but they are not the same as insured bank deposits. Different tokens have different protections, rights, and risks. Traders use stablecoins because they make it easier to move between crypto assets without returning to a bank account every time. On exchanges, a stablecoin can work like a parking place for value between trades. Stablecoins can also be useful for payments. They can move across borders, settle on blockchain networks, and operate outside normal banking hours. For people and businesses that deal globally, that can be attractive. When you tap a card at a store, the payment may feel instant, but the behind-the-scenes settlement can involve several companies and delays. With stablecoins, the token transfer can settle directly on the blockchain network. Stablecoin payments are not always cheap. The cost depends on the blockchain, network traffic, wallet, and exchange involved. Some networks are built for low fees, while others can become expensive when demand is high. To use stablecoins, you need a wallet or an account with a service that holds them for you. Holding your own wallet gives more control, but also more responsibility. If you lose access, there may be no easy recovery. Many centralized stablecoins include controls that can freeze tokens in certain situations, often for legal or security reasons. Some users see this as necessary for mainstream adoption. Others see it as a limit on crypto independence. Governments care about stablecoins because they look like money, move like crypto, and can become important in payments. Regulators often focus on reserves, consumer protection, financial stability, and anti-money laundering rules. Stablecoins do not completely replace banks. Issuers often still need banks to hold cash, process redemptions, and connect to the traditional financial system. In many cases, stablecoins are a bridge between crypto and banking, not a total escape from banking. Stablecoins are also different from central bank digital currencies. A stablecoin is usually issued by a private company or decentralized protocol. A central bank digital currency would be issued by a government central bank. They may both be digital money, but they are not the same thing. You might wonder how stablecoins differ from regular payment apps. A payment app usually moves balances inside a company database. A stablecoin moves as a token on a blockchain, which means it can interact with wallets, exchanges, and smart contracts across that network. In decentralized finance, stablecoins are a core building block. People use them for lending, borrowing, trading, and liquidity pools. They give DeFi users a dollar-like unit of account inside systems that run on crypto rails. Beyond trading, stablecoins can support contractor payments, remittances, marketplace settlements, and treasury movement between crypto platforms. The value is not that they are exciting. The value is that they can make digital money programmable and easier to move. If you are trying to understand a stablecoin, ask a few simple questions. Who issues it? What backs it? How can it be redeemed? Where are the reserves held? What could cause the peg to break? Those answers tell you far more than the name of the token. A stablecoin can lose its peg when confidence drops, reserves look weak, redemptions slow down, collateral crashes, or the market structure fails. Sometimes the price returns, sometimes it does not. The design and the response both matter. A stablecoin is a crypto token that tries to keep a steady value, usually around $1. It matters because it gives the crypto world a more stable unit for payments, trading, and financial apps. But stability depends on reserves, design, trust, and risk management. Stablecoins are one of the most practical ideas in crypto because they connect digital money with everyday value. They are not perfect, and they are not risk-free, but understanding them is essential if you want to understand where crypto payments and digital finance may be heading. What part of stablecoins still feels confusing to you? Ask your question in the comments, or suggest the next topic you want explained in plain English.